Does investing always make you rich? If that's true, why aren't millions of investors already millionaires? Today, we're going to uncover a truth that many people never talk about. When people think about investing, they picture billionaires. Names like Warren Buffett, Elon Musk, and Jeff Bezos immediately come to mind. Their incredible success makes investing look like the perfect path to wealth. Social media makes it look even easier. Every day, you see headlines about people making thousands or even millions from stocks and cryptocurrencies. It almost feels like everyone is getting rich except you. Luxury cars, private jets, expensive watches. These images create one powerful message. Investing equals success. But have you ever asked yourself one simple question? If investing is really that easy, why doesn't everyone become rich? Every success story has thousands of failures hidden behind it. The people who lose money rarely become viral. Most of them disappear quietly, taking their mistakes with them. You see the winners? You rarely see the millions of ordinary investors who bought at the wrong time or sold at the worst possible moment. So here's the real question. Is investing actually the secret to becoming wealthy, or is there something much more important? Meet Peter. He's an ordinary office worker with an average salary. Like many people, he dreams of building a better financial future. Every month, Peter pays rent, groceries, transportation, utilities, and other bills. After covering all his expenses, only a small amount of money is left. Instead of spending those savings, Peter decides to invest. He believes it's the fastest way to escape the cycle of living paycheck to paycheck. Saving money is a great first step, but having money to invest doesn't automatically make you an investor. Peter starts watching financial videos online. One creator says, "Buy this stock." Another says, "Bitcoin is going to the moon." Everyone seems absolutely certain. With so many opinions, Peter becomes confused. Who should he trust, and how does he know who's actually right? Standing between excitement and uncertainty, Peter faces the same decision millions of people make every day. Should he follow the crowd, or should he first learn how investing really works? One day, Peter notices something unusual. An AI company's stock has skyrocketed over the past few months. Everyone online is calling it the opportunity of a lifetime. Without reading a single financial report, without understanding the company's business, Peter buys the stock anyway. At first, everything seems perfect. The stock keeps climbing. Peter watches his portfolio grow day after day. His investment is already up 30%. Peter begins to believe he's naturally talented at investing. He even starts giving advice to his friends. Then, something changes. The market suddenly turns red. What looked like an unstoppable rally quickly becomes a sharp decline. Peter tells himself, it will recover tomorrow. But tomorrow becomes next week, and the losses keep getting bigger. Fear begins to replace confidence. Every news headline sounds terrifying. Every red candle feels like another step toward disaster. Unable to handle the pressure anymore, Peter finally sells. He locks in a painful loss, believing he has made the right decision. A few weeks later, the stock begins rising again. Peter watches from the sidelines, wondering what went wrong. The problem wasn't the stock. The problem wasn't even the market. The real problem was making decisions based on emotions instead of knowledge. This happens more often than you might think. People buy because prices are going up and sell because prices are falling. Psychologists even have a name for it. FOMO, the fear of missing out. It pushes people to chase opportunities they don't truly understand. The same story happened in the cryptocurrency market. When Bitcoin and many other coins reached record highs, millions of new investors rushed in. Some projects later collapsed almost completely. Many investors lost years of savings because they invested in hype instead of understanding the risks. The biggest lesson isn't that stocks are dangerous. It isn't that cryptocurrency is evil. The real lesson is simple. Buying something you don't understand is never an investment. It's a gamble. After losing money, Peter had two choices. He could blame the market forever, or admit that he still had a lot to learn. This is where most people quit. They say investing is nothing more than gambling. But the truth is, gambling and investing are not the same thing. A gambler hopes for luck. An investor searches for value. That single difference changes everything. Instead of chasing the next hot stock, Peter starts reading books about investing, business, and financial psychology. For the first time, he realizes that successful investing begins with education. He learns that every investment should answer a few simple questions. How does this company make money? Can it continue growing? And why should it be worth more in the future? Peter also discovers that even great companies can become bad investments if you pay far more than they're actually worth. Price matters just as much as quality. He stops trying to predict tomorrow's market. Instead, he focuses on businesses that could still be successful 10 years from now. Peter no longer invests all of his money at once. He spreads his investments over time. This simple habit helps reduce the risk of buying at the worst possible moment. He also learns one of the oldest rules in investing. Never put all your eggs in one basket. Diversification can't eliminate risk, but it can prevent one mistake from destroying your future. Peter still owns a small amount of cryptocurrency, but now it's only a small part of his portfolio, not his entire future. He understands that high potential often comes with high risk. He builds an emergency fund before investing more because if life forces you to sell your investments during a market crash, even a great investment can become a bad outcome. Successful investing isn't about finding a magical stock. It's about managing risk, controlling emotions, and staying patient. Those skills matter far more than luck. Years begin to pass. Peter's portfolio doesn't double overnight, but it grows steadily, year after year. That's the part social media rarely shows. Real wealth is usually built slowly, through consistency, discipline, and time. Peter finally understands something that changes his life. The greatest investment wasn't the stock he bought. It was the knowledge he gained before buying it. Peter isn't a billionaire. He isn't driving a private jet, but for the first time in his life, his money is working for him instead of sitting idle. The biggest difference between successful investors and unsuccessful ones isn't intelligence, it's discipline. Successful investors follow a plan, even when emotions tell them not to. Think about Warren Buffett for a moment. He didn't become one of the richest people in the world by chasing every new trend. He became wealthy by following a simple strategy consistently for decades. Markets will always rise. Markets will always fall. No one can predict every move with certainty, but history has shown that patience often outperforms panic. This doesn't mean every investment will succeed. Even the world's greatest investors make mistakes. The difference is that they manage their risks before chasing their rewards. So before buying your next stock, before investing in the next cryptocurrency, ask yourself one simple question. Do I truly understand what I'm investing in? If the answer is no, don't rush. Take time to learn. The market will still be there tomorrow, next month, and even next year. Remember this? The goal of investing isn't to get rich overnight. The goal is to build wealth slowly enough that you can actually keep it. People often believe money creates successful investors. In reality, successful investors create money through knowledge, patience, and disciplined decisions repeated over many years. So, does investing make you rich? Not by itself. Knowledge makes better decisions. Better decisions create better investments. And over time, those investments can build lasting wealth. Before you invest your money, invest in your knowledge first. If you enjoyed this video, don't forget to like, subscribe, and share it with someone who thinks investing is a shortcut to becoming rich.